Good afternoon, everybody. Welcome to Tech Talk here at MarketStream.live. My name is Joseph Cusick from the Cusick Group, securities offered by MoneyBlock. Here to marry charts, take a look at what's happened in the past, and option pricing, what it's implied as far as future movement in some underlying stocks and sector ETFs. And today what I want to focus on is a beaten down sector right now, and that's crude oil. The energy sector is under pressure today, and crude is leading the way. The reason why I want to focus on this is there's some major data that's going to be coming out after the close today, beginning of tomorrow, and then on Friday. The API data, the American Petroleum Institute will be releasing their data on supply after the bell. And the EIA, Department of Energy, will be giving its petroleum data out at 10:30 a.m. Eastern Time. Also, we're going to have the Department of Energy release their natural gas storage data as well, and that's going to be released at 10:30 Eastern Time at the same time as crude. So I wanted to take a look at those contracts, and I'm going to use the ETFs because a lot of you out there don't have access to or don't utilize futures. It's worth taking a look just to get to understand the products, but we'll use the ETFs that are proxies. The first one I want to start off with is USO. USO tracks the crude contract. It's trading at 1107. It's down about 24 cents today. And when you look at the options right now, the options are pricing in for the next 3 days a range of 34 cents. So that means that it could be up as high as 1150 or as low as we're going to get in the range of right around $11. Now, when you take a look at that over the next 10 days in the options, it's pricing in a 50-cent range. So you could see it as high as 1160, 1158, or you could see it as low as 11, a little bit below. So there's quite a decent range, anywhere between a 2.5% to 5% range being priced in to UNG in front of this data report. Now, the implied volatility rank, for those of you that don't know what implied volatility is, it's just that forecasted of expected moves. And the lower that rank is, the lower expectations are that it's going to be a big, violent potential move, or at least the potential for a violent move. And the implied volatility rank right now on UNG is at 15%, so it's very low. Taking a look at some notable areas that you want to watch as far as price action, as far as support and resistance, 1154. That was the previous support level and also the trend for the short term. When nat gas was trading over 1154 on UNG, the trend was bullish. It broke that a couple days ago pretty significantly with a gap. And now we're looking at midterm support at right around 1095. That's that institutional support or that 50-day moving average. Right now, the current short-term trend is to the downside, but it's holding right above that 1095 level. You're going to want to see it hold above there because that's where conviction could come in, especially if there is a bullish report that comes out tomorrow. 1091 is long-term support overall for the UNG contract. That's the 200-day moving average. That's where you're going to want to see overall support being held if, in fact, the bullish trend could have an opportunity to continue on the upside. And again, we have a catalyst tomorrow with the natural gas, or with the crude oil inventory report tomorrow and this evening. Now, taking a look at UNG and nat gas, it's trading at around 817, and nat gas has just been pounded as well, even worse than crude oil has over the last few sessions. As a matter of fact, it is up 38 cents today, but that was off of some really poor levels yesterday. Right now, over the next 3 days, nat gas contract has a range being priced into it of 38 cents. That means you could see it as high as 840, 850, or as low as right around 790. So we're going to keep an eye on that. It has a 10-day range of around 60 cents, specifically 59, but we'll round up a penny. And so basically you're looking at somewhere around a 765, 77, or 865, 870 range to the upside. And you could see it get down as low as 790, 780 in the next 10 days. As far as the the UNG contract or nat gas contract is concerned. Implied volatility, though, is heightened. It's at 66%. There is an expectation of violent moves, and if the nat gas inventory data comes out tomorrow, it could tilt the market in one direction or the other, and there is an implied forecast that it could be pretty violent, either to the upside or to the downside, with a rank of 66%. Now, what are some critical levels you want to watch? 871 on the upside. That would resume then the trend to the upside. It would also put the short-term trend in the bullish camp. 829 needs to be retaken or at least held over the next few sessions. It's below that right now. That's the 50-day moving average. That's what I also call the institutional moving average. If it is a negative report that comes out and the trend starts to shift to the downside even more, that could get institutions nervous. You could see a dump in UNG further. 795 is going to be the long-term support level. That's the 200-day moving average. You want to see that held into the number, after the number, if in fact the nat gas contract is not getting more bearish overall. Finally, I want to take a look at Baker Hughes, ticker symbol BHI. The reason why, one of the big components of why the crude contract is getting beat up so bad today is there's a lot of discussion with crude over $50 that a lot of the rig counts are going to start to increase here in the United States. In other words, they're going to start pumping again. Yes, there's also the OPEC and non-OPEC concerns about whether or not they're going to adhere to the production limits that they have put in place back in their December meeting. But the point being is that there could be more supply coming online if, in fact, these rig counts do actually increase. Baker Hughes will be announcing their rig count on Friday. We're going to watch that number very closely. Stock's trading down 47 cents at 62.77. Over the next 3 days, the options are pricing in that this stock could have a range of $1.45. So you could see it as high as 64.5 or as low as basically right around 60 and 61, let's just say. You're also seeing a 10-day range of over $2, $2.19 to be exact. So you could see this as high as 65 or as low as 60 and some change. The implied volatility rank, though, in Baker Hughes is relatively low at 18%. Critical levels you're going to want to watch. If, in fact, the bulls are going to start taking control, they're going to have to first take 62.70 and keep it there. That's a critical institutional level. It's pulled off of its bullish trend, short-term trend level of 65.10. It would need to retake that if the bullish trend on the short term was going to continue. But 62.70 is that institutional level that we'll watch very closely. A break of 62.70, well, you got long-term support down at 51.10. So that's quite a bit of distance away. So it'd have to be extremely negative on the rig count and just the overall fundamentals of the crude markets to pull it down to its long-term 200-day moving average of 51.10. All right, folks, that's the way I look at it using charts and option analysis to give you that transparency, those ranges. Now you can start looking at it strategically much clearer. All right, I'm going to be back online at 4:30 Eastern Time. I'm going to wrap up today's closing action here on the markets. Join me here at MarketStream.live. Take care and have a great day.